What's up, everybody? Crypto Noah back with another video showing you how you can put your idle crypto assets to work and generate passive income within the decentralized finance space. In this video, we're going to be talking about the top protocol when it comes to automated liquidity management, and that is Arrakis. So before we get into this video, I do have to say that this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like we always say, do your own research, but use this channel as a starting point. So in this video, we're gonna go through the Arrakis docs like I've been through the last few videos. I'm gonna do a platform walkthrough. I'm gonna show you their yields. And then at the end, I'm gonna show you if I would use the platform or not and why. So without further ado, let's get into the content. So here we are on the docs for Arrakis Finance. And it says Arrakis is Web3's trustless market-making infrastructure protocol that enables running sophisticated algorithmic strategies on Uniswap v3. Liquidity providers can utilize Arrakis's vaults to have their liquidity be managed in an automated, capital-efficient, non-custodial, and transparent manner. So if you're interested in the history, they pretty much tell you like why they started the platform. You know, they wanted Uniswap v3 pretty much to be easier. Go into their problem statement. It says DEXs like Uni v3 lack a sophisticated and decentralized market-making infrastructure to harness the true potential of concentrated liquidity. Concentrated liquidity is being able to provide liquidity on a decentralized exchange and choose the price range that you want to provide the liquidity for. So instead of going into ETHUSDC and allowing your liquidity to be used from no matter what the price of ETHUSDC is, you can say, hey, only use my liquidity from 1,000 to 2,000, for example. It makes your capital more efficient. But if you don't know what you're doing, you can also lose money through something called impermanent loss. So it says here, legacy AMMs, which stands for automated market makers, lack the efficiency to rival their SEX, aka centralized exchange counterparts. So it says most crypto asset trading volume still occurs on SEXs. These have shown time and time again that their custodial nature make them prone to attacks and fraudulent behavior, ultimately resulting in high risk, leading to users losing their funds. Then it says, meanwhile, the concentrated liquidity nature of Uni v3 provides a solution to the low capital efficiency of legacy AMMs. However, this gain in efficiency comes at a cost of substantially higher complexity and risks. Without the layer on top of these concentrated AMMs that help to realize the liquidity efficiency potential while making it accessible to a wider audience, DEXs like Uni v3 will still lag behind their centralized counterparts. Then it says traditional market making solves the complexity for centralized exchanges. It says this layer, which is built on top, has long been present in traditional SEXs. This is the reason why they still have the vast majority of trading volume of crypto assets today. For most assets, SEXs still provide significantly tighter spreads and more efficient asset allocation. The primary reason for this is because SEXs have access to a mature ecosystem of institutional market makers. Even though traditional market makers are custodial, non-transparent, and expensive, market participants like protocol teams still have to use them today, as they are not the only way to gain deeper liquidity on exchanges. So just to translate this a little bit, the same thing that we're doing within DeFi, this isn't new, concentrated liquidity. This is how market makers provide liquidity on centralized exchanges, what they're talking about. So when you go and buy your Tesla on Robinhood, it's companies like Morgan Stanley, Goldman Sachs, et cetera, saying, hey, here's 100 million in Tesla, here's 100 million in cash. Only use my liquidity when the price of Tesla is between X and Y. And they profit off what's called the bid to ask spread. This is concentrated liquidity in traditional finance. And what they're saying is there isn't a platform on top of Uniswap v3 to help with the process of deploying a profitable strategy that's in line with the person or the institution, market makers that they're talking about here, to make it easier. So they're aiming to be that platform that gives you a few strategies that can, align with your goals, because they're saying it's too complex. They're also saying that because of the lack of a platform like theirs built on top of Uni v3, that's the reason why most of the trading is happening on centralized exchanges. I disagree with that point, because I think the reason why there isn't a lot of trades happening on decentralized exchanges is because it's still a fairly new concept. When the internet came about, everything goes through an adoption curve. Like, people thought we never see a day where you're using your credit cards to buy things online. People didn't think there would be a computer on every desk. This Uniswap is already doing more daily volume than Coinbase sometimes. So we're seeing the use of DEXs trend upward. And yeah, I feel like a layer like this can help, but I'm not sure if I fully agree with that point. I think it's more so an adoption curve thing, not a lack of things on top of Uniswap, because there are things on top of Uniswap. And to be honest, if you know what you're doing, I don't think using the Uniswap platform to provide liquidity is all that complicated. But I digress. Let's keep going. All right, now they go to talk about the solution. All right, so it says who can use Arrakis. So first they talk about liquidity providers. All right, and they can select 3 different options that define how their liquidity gets managed. Let's go through these. The first one is trustless vaults. So these are vaults that have a smart contract with a predefined strategy as their manager, which enables LPs to have trustless, autonomously managed on-chain strategies similar to a curve 2 type model. And these can be static or dynamic. So it's basically you're trusting the smart contract. Things are programmed into the smart contract to, handle your strategy. And if you look at this graph here, the trust assumptions is low because you're trusting the smart contract. The performance is low, possibly, and the complexity is low because it's automated. The second thing is managed vaults, and these are vaults that are operated by professional market makers running more sophisticated off-chain strategies. All right, so the trust assumptions is high because you're having to trust someone else. Even though, trusting a smart contract and trusting someone else, you're still trusting what someone put into that smart contract. So I feel like this should be high as well. The performance is high, supposedly, because it's from a market maker who has experience, but, that's not guaranteed. And the user complexity is low because you're pretty much trusting them to do it and you're not having to do anything. The third one is self-managed vaults, and these are vaults that can only be used by single entities which are also the manager at the same time and thus have full control over it. These are only for advanced users. And it says trust assumptions low because you're doing it. Performance, it's a line because it depends on how you conduct the strategy. And the user complexity is high because they're saying Uniswap v3 is high. And then it says here, in regards to professional market makers, the other possibility exists for market makers and sophisticated traders that can offer to manage the liquidity of other liquidity providers for a percentage share of the fee earnings. All this occurs on chain, meaning that the protocols can monitor how these market making strategies are performing transparently. Now, to be honest, I disagree with this last point here. So it says low, and it's a dash, and it's high user complexity. And then let me explain why. I've lost most money investing, relying on someone else. Just keeping it real with you guys. As you're gonna see on this protocol walkthrough, I don't see how you can track the performance of these pools. Yeah, it shows the APR, it shows like the ratio of different assets, like how things are balanced. Like for example, 60% ETH, 40% USDC, but I can't track the historical performance. And when I can't track the historical performance, I don't know what I need to adjust. I have to keep trusting. So in regards to performance, we here at Know It Owls teach you how you can become a professional yield farmer so you don't have to rely on anyone else. Our course goes through literally everything from A to Z, technical analysis so you can master your entries and your exits, security so you don't get hacked, how to develop the mindset of a successful investor, because investing is that one thing where you need to go against your emotion and your intuition to a certain extent. So looking back on that graph, the trust can be high because we're going to help you to trust yourself. The performance is going to be high because we're going to give you all the tools and education and strategies that you need to be able to know when to get into a pool, how to track it, when to get out, when to compound, when to send rewards to another wallet, like help you come up with a strategy that best aligns with your personality. And then that would bring the user complexity really, really low, right? Because you'll understand how to do it. So you can, by going through our program, you can have everything on that box green. And the cool thing is you can start with a small amount of money. You can start LPing with $5, and then you can learn what mistakes you're making and be able to use that data to create a better strategy. Then once you got the hang of it, you can put more money into it. So if you're interested in something like that and you want to become a yield farming professional and deploy the same strategies as the large market makers, click the link in the description, the Calendly link, book a free strategy session with me. I'm going to see if you're a good fit for our program, ask you a few questions, what your investment goals are, where you are on your investing journey, to see if we can meet you and ultimately see if this is a good fit. If it's not, I'm sure we'll be able to point you in the right direction and still be able to answer your questions and teach you a thing or two. So I digress. Let's get back into the platform. All right, so let's get into their key features. And this is mainly outlining like their version 2. Their version 1 was a lot, simpler and didn't have as many features. So the first feature they have is multiple concentrated liquidity positions. So this enables the construction of an arbitrary combination of liquidity provisions on Uniswap v3 pool. The second one is cross fee tier vaults, and this enables liquidity provision in different fee tier pools simultaneously and moving liquidity across fee tiers seamlessly. So like, for example, let's say you're in an ETH USDC pool and you have a tier where it's 1%, 0.3, 0.5. It sounds like it can move you to the fee tier where most of the volume is happening. I don't know if they're taking out gas fees and all that. If it's on ETH mainnet, that's a big thing. If it's on Arbitrum or something else, it's not as big of a deal. But what I found is that, switching different fee tiers and different chains is kind of like when you're driving in traffic, one lane next to you starts to move fast. So you hop in that lane just for it to slow down, and the lane you just came from starts to move fast. So that's why we teach like how to set up pools on different networks, different tranches, so that you're maximizing your profits while also hedging risk. So that way you don't ever have to miss out on good yield. The next one is inventory management. And this enables using only a certain portion of the deposited capital for LPing at any given time, with the option of connecting to swap routers. So, I don't see how this is super groundbreaking because, like let's say you have $10,000 and you want to yield farm with 5K. Just put 5K in a pool, select your range, and you can monitor it versus having to put 10K into their smart contract and tell them to only use 5. I don't know. Maybe that's just me. The next one is cross-protocol rebalancing. And this enables aggregating liquidity sources from DEXs or directly mintable protocols. The next one is non-custodial. This ensures that liquidity deposited by an arbitrary depositors can be withdrawn anytime, only by the depositors themselves, as managers do not have custody over the liquidity deposited. I mean, that's pretty standard with the DEX. And then it says they're fungible, so the fungibility of Arrakis vaults make them highly composable and enables an easy integration into DeFi and can be used as collateral in lending markets. All right, now they go to talk about their vaults. It says vaults are the vehicles that carry all the features of Arrakis v2 and also the interface where users can deposit liquidity in the protocol. They come with different properties and dictate who can deposit into them. You can look at ETH/USDC as a vault, like any pair as their own vault, because it's going into that vault so that people can trade from that vault and you get paid passive income from that vault. It says they have two types of vaults here, which is pretty cool. They have private and public, and private vaults allow only whitelisted addresses to deposit into them. Example, they can be used by a protocol or a DAO for protocol-owned liquidity. And obviously public vaults are anyone. So I feel like that's pretty cool. Like let's say I would prefer to use something like Enzyme for this because it gives you the performance, it gives you what pools they're in, it gives you way more data. It's almost like an on-chain hedge fund. And you can like have paperwork required for people to sign, but they're saying in these private vaults, you can whitelist addresses and say, hey, hit up your 10 friends and be like, hey, I'm doing this strategy in this pool or whatever. You can go ahead and send me your wallet address. I can whitelist it if you want to jump in the pool. That's pretty cool. And then within those vaults, they have the three that we went over: self-managed, managed, and trustless. Now let's go over some examples. It says a few typical use cases to demonstrate how to implement market making strategies through Arrakis. So it says case 1, pegged asset pairs. It says for a pair of pegged assets, in order to allow for large size trades close to the peg, a large portion of the liquidity is in the 0.01% fee tier. In order to hedge liquidity providers' risks further away from the peg, the liquidity is automatically provided in the 0.05 and the 0.3 fee tier. Meanwhile, there can still be a good amount of sideline assets inside the vault, which at any point of volume or volatility can be injected into the market as extra liquidity. So my thoughts on this is as follows. I don't know, and I could be missing something. I don't know how it's hedging risk, putting in another fee tiers, because like let's say, for example, ETH/USDC. Hedging risk would be setting up a position that is favorable to the price of ETH going up or down against USDC, because it doesn't matter what fee tier you're in, 0.3, 0.5, 0.1. If the price of ETH is going up or down, depending on how your pool is set up, you're going to experience impermanent loss. So I'm not sure how this is a hedge, but I guess it is a cool thing to where if volume's picking up in one fee tier, you go there. Hopefully that's not, like I said, taking out gas fees from you, especially on ETH. And it's also like that volume can change in a fee tier at any time. And it's also fee tiers where predominant of the volume is being used. And those are usually the ones I pick. So I'm not sure how useful this is, but if someone has experience using something like this, please make a comment down below. I'm not trying to bash the protocol. I appreciate anyone trying to build anything within DeFi, trying to make the process easier for just the space as a whole, and especially liquidity providers. I'm just giving you guys my honest take. Case 2 is volatile pairs, and volatile pairs are like volatile assets. So like ETH BTC is a volatile pair because both of these, Bitcoin and Ethereum, are both volatile. So it says, conversely, on a volatile pair, a liquidity distribution can be set up similarly to a centralized limit order book, where further away from current price, the liquidity is deeper due to the larger spread. So I guess this is a cool feature, but nothing is all good or bad. Like if volume starts to move in one way and they go heavier into that tick, price can easily turn around. And if they're like rebalancing, then that's locking in permanent loss. So that's one reason why I prefer to like do the strategy on my own, because sometimes I'd be willing to like sit through that, because impermanent loss can actually be your friend if you know what you're doing. So now let's dive into their Palm feature. And this stands for Protocol Automated Liquidity Management. And it says it's leveraging the unique features of V2. It enables protocols and DAOs to create deep liquidity for their tokens. This is achieved by acquiring the required base asset inventory needed to create deeper sell-side liquidity using the organic trading demand with UniV3, rather than selling tokens or paying third parties to rent inventory. So they basically, if you want to launch a token and you want to create deep liquidity, meaning people will be able to buy and sell a large amount of it, they can help with that without causing slippage and massive price swings. So this one goes to talk about their Palm versus liquidity mining versus bonding. So it says these are 3 mechanisms that offer different ways to make tokens liquid. So they talk about the inventory problem. So it says in order for a trading pair like Uniswap USDC to become liquid, someone has to provide a sufficiently large inventory of the base asset, which is USDC, and the quote asset, which is Uni. This is called the inventory problem. So it says each mechanism tackles this problem from a unique angle. The liquidity mining angle is protocols rent liquidity from investors that are willing to deposit capital in an AMM in exchange for token rewards for a short period of time. So basically, let's say I want to launch a token. I'm going to hit up some investors like, hey, I need some liquidity so that people can be able to trade this token. And the investors will be like, all right, they'll deposit some liquidity within the pool and they'll get like some token rewards. So like, let's say I'm giving away Noah token. They provide liquidity for Uni USDC. And not only are they getting the trading fees from Uni USDC, but they're also getting Vince token, just as an example. The next one is bonding. In bonding, protocols sell their own tokens at a discount for LP tokens in one or multiple OTC deals. So basically, like let's say I have Vince token. I sell some of those tokens for LP tokens, liquidity provider tokens. So it's like I have liquidity, right? And I'm doing this over the counter at a discount. Now let's talk about the Arrakis Palm solution. So using Palm, the base asset inventory is acquired by market making on Uniswap v3. For example, imagine a scenario where the Uniswap Foundation provides Arrakis with 100% Uniswap and 0% USDC. Arrakis vaults using Palm will actively manage the inventory to transition the 100 to 0 ratio to roughly 50-50 without ever directly swapping any assets itself on the DEX. It achieves this by only charging the allocation of the base and quote asset respectively that it provides into the market. This means neither red candles nor negative price impact will ever be caused using Palm, as opposed to liquidity mining and bonding, since Palm will only provide liquidity and never actively sell the quote asset. Once a 50-50 asset composition is reached, any market making strategy can be utilized to maintain the desired inventory target composition and keep the market as liquid as possible. And if you want to know how it works, you can go through these docs here. I still haven't fully wrapped my head around it, because it's just like, I guess they would just be okay with experiencing a fuck ton of impermanent loss and taking all that on their own, is what it sounds like. But yeah, you have to apply to use Palm. Right now, it's currently limited. So if that's something you're into, feel free. All right. Like we always say, security is one of the most important, if not the most important thing when it comes to DeFi, because it don't matter if you have risk management, a good strategy, all that stuff. If you get hacked, all that shit goes out the window. So whenever I'm allocating funds into a protocol, I want to look at the TVL, the history, and more importantly, the audits. It looks like they've been audited by 3 different auditors, is what it says here. And I went through them. I have one pulled up here. I always like to say it's not all about getting an audit, but it's about realizing the bad things that's wrong and fixing them. So they had issues found, 5 medium issues found, 2 high issues found, and then it says issues not fixed or acknowledged, none of them. So that means they fixed all the issues, and that's a really, really good sign. And like I always say, these audits are not cheap. So the fact that they got an audit, saw issues, got an audit, fixed issues, got an audit, fixed issues 3 or 4 times, it shows that this project is actually serious, which is good. Lastly, I like to check the TVL and see how this protocol stacks up to its competition. And if you look at Arrakis, you can see they are number 1 in terms of TVL versus all liquidity managers. The one behind them is Gamma, and that's going to be the next video I make. And if you click on Arrakis, you can see their growth. They rose and fell with DeFi, right? So they started, it looks like in around July of 2021. At their peak, they got up to 1.8 billion, which is pretty impressive. And even with FTX and Terra Luna and Celsius and BlockFi dropping, they still have 177 million in TVL. I think that's really, really good. So now that we went through all the docs, we went through the audits, etc., let's do a platform walkthrough. And at the end, as promised, I'm going to tell you if I would use this protocol and why or why not. So here we are on their website, and it looks pretty cool. You know, it talks about what they do, some of the strategies you got here, pretty cool graphics. It looks like these are protocols that actually use them as a liquidity management system is what it says here. Actually, before we finish going to that, this is the last thing I forgot to cover, the fees. So it says, Arrakis V2 is permissionless and has no fees. Deploying vaults and using V2 is completely free. Managers who are managing vaults may, however, charge fees that they deem appropriate. So it says the Palm is a 1% per year fee over the principal and a 50% performance fee over the trading fees the vault generates. So I definitely wouldn't be depositing any money into any Palms so that someone can manage it, but I would deploy a Palm. So yeah, now back on the website here, I wanted to see who their investors are, because the fact that they're able to do this and not charge any fees, it signals that they might have some investors, which could also signal a token airdrop, but I don't see anything regarding investors. So it could be bootstrapped, and maybe they're just worried about getting users. Either way, the fact that they don't have fees, that is a really good thing. So now let's enter app and let's check out some of these yields. So you can sort by the network. They're on Ethereum, Polygon, Optimism, and Arbitrum. I'm going to just sort by all, and I want to sort by APR. So you got wrap stake ETH USDC for 98.84%, and it says this is a volatile strategy. So when I click on this, you can look at the composition. You can look at, how they've been rebalancing it and whatnot, it seems like. You can look at the about, and then you can look at the risk. So smart contract and permanent loss. The strategy is unhedged, meaning you're taking directional risk. Okay, I don't see anything regarding performance. Let's see what happens when I click vault address. All right, so I'm gonna copy this and see if I can plug it into Revert Finance and track performance. Paste an address here, click go. Yep, so I don't get to see anything. Normally, like when I put it in my wallet, it'll show all the pools I'm in. I put in the address. So yeah, I don't know how to track the performance of that pool or any of their pools on their website. So when they say this thing is like transparent, I'm not sure how transparent it actually is. And if I'm missing something, whether if it's the Arrakis team or someone in the comments and you know how to track them, please let me know. I'm not trying to bash this protocol. I really do like it. You got wrap staked ETH USDT, 16%, 10% on ETH, Rocket Pool ETH, I think that's what it is. Let's see what else they got here. That can't be all of them. Yeah, that can't be all of them because they have 177 million TVL, and this is like only a few million I'm looking at here. Maybe let's see ETH. Okay, ETH, they only have 3 pools on V2. Polygon, no vaults. Okay. Optimism, 2 vaults. Arbitrum, 3 vaults. Okay. I guess let's see V1. Has to be the vaults that have to be on V1. We're going to sort by APR. Network, we're going to go all. Okay, so we got 7.91, 1.8, 3.7. Nothing really too crazy. Wrapped ETH and CB ETH, 1500%. I'm not sure what CB ETH is, but I don't know if I would touch that. The yield's pretty high. OPUSD, not bad. It also doesn't tell me if it's like one of those managed ones where the fees are being taken out. Yeah, so it's like I don't even know if this is one of the pools where if I put my money in that it's going to be taken out because it's managed by a certain person. I'm not sure how to tell the difference here. But yeah, oh, here's a good one. Well, I don't know what Unidix is, but 148%, 17% Ratmatic Aave. It's not too bad. Unibright, haven't heard about them in a while. I wonder if they're still building. And 19% ETH Laura. So yeah, it looks like most of the yields are on V1. Yeah, but the yields aren't that good though. Wrap ETH ENS 22%, fee tier 1%. Okay. 78%. Yeah. Yep. If you guys want to come on here and look through these, it looks like most of the vaults are on V1. So now we went through everything, went through the yields, went through the docs. Would I use this protocol? And if so, why or why not? As always, it depends. So let me talk about the reasons why I would not use it first. I can't figure out how to track performance. Second thing is, even if I could, I feel like I could perform better and like deploy my own strategy that works for me using something like Aperture to where I can pick a price where it exits me out, or I can, rebalance with the touch of a button without fees. Aperture also doesn't charge fees. Like I said, if I can't track performance, I can't adjust. If I can track my own performance, I can see how I did, and I can say, okay, maybe I need to fix this, maybe I need to fix that. I can control when I rebalance. I can control when I exit the pool. Like maybe I don't want to rebalance because I don't want to suffer as much impermanent loss. Maybe I just want to accumulate an asset and take the profits out, send it to another wallet, employ a different strategy there, maybe single side staking, so I'm not subject to impermanent loss. Like it doesn't, you get a lot more customization doing it on your own, even though they offer you these different things. Because it's like yield farming is not a closed vacuum. It's not the end all be all. Like sometimes it's a good time to maybe not be yield farming, even though there's a strategy for crab markets, bull markets, and bear markets. But sometimes you want to just mix yield farming with trading and take your profits, set price targets for the assets you accumulated, sell them when you want. And the whole rebalancing can be, like I said, it's not always a good thing. And permanent loss can be your friend. Like if you're in the ETH USDC pool and it goes to the bottom and now you're out of range to the downside, well, hey, you just got paid to buy the dip in ETH. So now you got ETH for cheap. You can exit that pool, enter into a leveraged long yield farming position, or you can just hold the ETH until it goes back up, or enter into a spot yield farm position to where you take profits on the way up. So locking in that impermanent loss was like locking in your buy plus fees. I'm not going to say I don't worry about impermanent loss, but I don't worry about it as much because I would never provide liquidity for an asset that I wouldn't mind holding on its own. So if I'm in an ETH link pool and I'm out of range to the downside on one of those, I don't mind holding ETH or link. I'll never provide liquidity for a shitcoin that if it goes out of range, I'll be upset with holding that single asset. And I recommend you not either. Okay, let's talk about reasons why I would use it. I would use the Palm feature for sure. If I was launching my own token and I wanted to create some deep liquidity, I would test this out to see if it's what it's all caked up to be, because that is a really cool feature. So I would use the Palm. I could see myself wanting to try out the private and public vaults, like having like a gated pool where it's whitelisted and only certain members can get in there, and it's a strategy that I'm doing. If I were to want to do that, like I said, I think I would prefer to use Enzyme just because they give you more tools. But I do like that feature. And another reason I'll use it is if I just wanted to set it and forget it, even though it doesn't take a long time, and I would never, do that. I'm a person who wants to learn something and rely on my own. Like I don't have a problem with relying on people for certain things, but things like this where, I can have more flexibility, make more fees, and still, be able to do the things I want to do, I wouldn't do that. But for a person who maybe was just like, I don't want to learn this shit no matter what, but I still want to make passive income and just not think about it, even if it underperforms, thinking long term, then I can see that. So I'm just trying to look at the bright side. So with that, hey, I thank you guys for tuning in. Let me know which protocol you want me to cover next. If you have any feedback on this one, because there's a lot of things on here that I wasn't sure about, as you know, if you watched the video, comment down below. I offer all constructive criticism. Consider subscribing if you got value as well. And with that, I thank you for watching. Love all of you, and I'll see you in the next video. Take care.